Time now for a bit of the day's business news, starting with growth in China falling to a three-decade low. Cole Stangler here in the morning to tell us more. Morning to you, Cole.
That's right, Will. So annual growth rate in China falling to 6.1% in 2019. Now, that rate is actually not so much of a surprise. It falls in the official target that was set by Beijing, but it's still the worst annual growth rate we've seen in 29 years. That news comes just days after China signed a so-called Phase 1 trade deal with the United States, aimed at cooling tensions between the world's two largest economies. That trade dispute is one big reason why growth has slumped in China over the last year.
Global economic and trade growth is slowing down. Instability sources and risk points are increasing. Structural and cyclical problems at home are intertwined, and the economy is faced with mounting downward pressure.
Now, declining investment, another reason behind the drop in growth in China. While state-owned firms continue to invest heavily, foreign investment has fallen off slightly, as you can see here. Consumer spending has also cooled off to a degree, with the decline in auto sales marking the most visible example. Another factor still is the fact that the global economy is slowing down as China grapples with declining GDP growth worldwide. Beijing has aimed to counter these trends through a variety of stimulus measures, including cutting borrowing costs. Further measures are expected in the year to follow. Let's take a look now at the day's trading action. European shares off to a positive end to the week. The CAC 40 up around 0.5%, as you can see here. The FTSE also seeing gains. So after automaker Renault announcing an uptick in fourth quarter growth despite an overall sales drop in 2019, that's helped propelling the CAC 40 gains there. FTSE up around 0.3%. Meanwhile, the DAX over in Frankfurt up around 0.2%. Somewhat of a mixed bag on the Asian stock markets following those figures out of China. Actually, we've seen them now moving up to all in the green there into positive territory. The Nikkei up nearly 0.5%. Hang Seng and the Shanghai also showing gains and slight gains over on the Kospi and Seoul. Investors also still taking in the U.S. and China signing a truce in their trade war. That deal has lowered but not removed tariffs on hundreds of billions of dollars worth of goods. Next up, a big milestone for the parent company of Google. Alphabet can now boast a market value of $1 trillion. Feats all the more remarkable given the growing scrutiny the firm has faced. Investors clearly don't seem to be all that bothered. Ken Monedelek has more.
US tech company Alphabet has reached new heights. Its market value has now surpassed the $1 trillion mark. It's the fourth US tech company to do so, along with Microsoft, Apple, and briefly Amazon. It's behind the hugely successful search engine Google, as well as Android, and has recently announced it was acquiring Fitbit. It's come under enhanced scrutiny of late. The tech giant is under investigation for unfair labor practices from the US National Labor Relations Board, and dozens of states are looking into whether Google violated fair competition laws. The European Union has already issued billions in fines, including a fine of over $1 billion in March last year.
Between 2006 and 2016, Google's behavior was illegal under EU antitrust rules. It prevented its rivals from having a chance to innovate and to compete in the market on their merits.
Politicians have also joined in the fray, with Democratic candidates Elizabeth Warren and Bernie Sanders both pledging to break up the company if elected in November. The French government, meanwhile, has already moved to crack down on Google and other large corporations with its controversial GAFA tax, which will impose taxes of 3% on revenue generated in France. But despite these pressures, Google doesn't seem to be slowing down. Investors are especially impressed by its foothold in online advertising. It holds around 70% of market share in the US.
And finally, another U.S. tech giant has unveiled an ambitious plan to curb carbon emissions. Within a decade, Microsoft says it's planning to go 100% carbon negative. That means removing more carbon from the environment than it produces. An ambitious pledge that'll be met by making its buildings fully reliant on renewable energy. Microsoft also says that by 2050, it'll remove all the emissions it's produced since it was founded back in the 1970s.
We need to continue to advance human prosperity. We will need to continue to generate and use more energy, but we need to cut the cord with carbon.
Well, growing pressure on companies to act on climate change. Also a well-timed announcement, World Economic Forum opening in Davos next week.
Indeed. Thank you very much, Cole. Cole Stangler with a look at the business story.